This is your chapter on personal finance, chapter 10. In this video, we're going to start with the basics of finance, in case anybody has never thought about investing or saving money. So, to start off, we're going to start talking about financial institutions. There are various types of markets where people buy and sell different types of savings products. And it's in these markets where the people who are selling and the people who are buying come together. And this means that one person is going to borrow money and one person is willing to lend them money. And that is the way that savings works. So you can buy bonds as one form of savings, and that means you go into the bond market, and there are people trying to sell their bonds, and there are people trying to buy a bond. If you wanted to save, you would buy a bond. A bond is a form of savings that you can purchase directly from the federal government, or you can buy it from somebody who is trying to sell off the bond that they currently have. So a bond is just a certificate of indebtedness, meaning if I buy a bond from the government today, and let's say it's a 10-year bond, that just means that the government is going to, in 10 years, pay me back my money plus interest. So it's typically a longer term savings plan, but generally has a higher rate of return than a basic savings account. So it's fairly low risk, but it's also fairly low interest. So it's a fairly easy way to save, but you generally have to hold on to bonds for longer periods of time. You can also go into the stock market. And just like any other market, there are buyers and there are sellers. And the stock market is where people can purchase up an individual stock, which would give you partial ownership of that particular firm. And firms sell all sorts of different types of stocks. You can also purchase a stock from somebody else who was once a stockholder who's now trying to sell their shares. So this is a lot higher risk. And therefore, there is potential for higher return or potential for a really big loss because you would have to know and research a lot about the company to understand whether you think their stock price is going to go up or down. And that's based upon what you think that particular firm is doing in the market that will show value over the next few years. Now, there are also financial institutions which are intermediaries, and these are groups that take your money and invest it for you in a more indirect way. So, for example, you can put money in your savings account, and you can go to your basic bank, put money in a savings account. Remember, when you put money in a fractional reserve bank, the bank doesn't keep it there. They remove the money and they loan it out to somebody else who comes into that bank wanting a business loan or a home loan. So your money is being invested for you, which is why your savings will return an interest rate. You just don't know where the bank is putting your money. You don't know which business they invested in. You don't know what package of investments that they're doing with your money. You can also buy groups of investments. A mutual fund is an example. A mutual fund is an institution where people manage and sell shares to the public in a portfolio of stocks and bonds. So somebody might manage this fund and put together a whole group of stocks and bonds as a package and then sell you a share of that mutual fund. And as that mutual fund rises in value, the share that you have in that mutual fund will also rise. Now, mutual funds are more diversified. A lot of times, investors like to diversify and get lots of different types of stocks and bonds. Again, bonds are less risky, stocks are more risky. And then you can buy stocks in various sectors: financial stocks, healthcare stocks, technology stocks. And if you diversify, then if there happens to be a recession that really hits the housing market pretty bad, or a pandemic that hits healthcare institutions really bad, then your entire investment is not ruined. Only portions of it will go down. So mutual funds are less risky because of diversifying. So it's less risky than betting on one particular company. You can also go ahead and do private savings. Now, the amount of money that any family is willing to save is the portion of your household income that is not going to pay taxes and is not going to do consumption spending. So you have to pay your taxes, and of course, you have to pay your bills and buy things to feed your family. The rest of the money that a family has goes to savings. Now, not every family has money left over to save, but some do. And that depends on how much money they're spending and paying taxes on. So you can always choose to put some of this in a private savings in just a regular savings account at a bank. But remember, banks lend to other customers. Your savings account at a regular bank is very low risk, but it's also extremely low interest. If you go to your bank's homepage and you can look under interest rates and see what rates they're offering on their savings accounts, the rate of interest, which is compounded monthly, is extremely low. But the likelihood that you would lose all the money in your savings account is also extremely low.